The way we have Warren Buffett and Charlie Munger of US, you three were that of India.
My first flirtation with the equity market was a failure. How do you go bankrupt in a bull market? I proved you could do that, because you have a lot more to lose at the end of your career than at the beginning of the career. And he must have started this when he was 40, 45. So even at that relatively ripe age, in the next 20 years, he's built a world-class business for himself among the top 50 companies in India. So extraordinary.
Hello everyone, thank you so much for joining us for season 2 of Finance Forward, where we have probably India's most prolific investor with us, Mr. Ramesh Damani. I think our audience, at least because you all are so invested in the field of finance and the field of education, I think majority of you all would know him. But for the few who don't, so Ramesh sir has been a member of the Bombay Stock Exchange. He's been in the industry, the investment industry for over 3 decades. He's worked with and I think you are known as the 3 R's of the market.
Probably an exaggeration.
Yeah. No. I think we'll come to that. Rakesh Jhunjhunwala, Rakesh Damani, and Ramesh Damani were in the market. They call them the 3 R's. They are the ones who actually drove the Indian stock markets forward I think till date. Over and above that, he sits on the chair of many boards, and most notably that of DMart and I think various other companies. Beyond that, if you go on Google and search for Ramesh Damani, not only will you find CNBC and money control articles, but overall as a media personality, he's been very vocal, sharing all his thoughts on, in fact, there is one of the most famous videos on YouTube for Indian investment, which is how to go from 10 lakhs to 100 crores, which was, I think, 5-7 years back you had shot. And over and above that, I've met sir a couple of times. He's probably one of the warmest, kindest individuals who's agreed to do this podcast with us. So with that, thank you so much for...
Well, first, thank you for a very kind introduction. You probably misstated the case that the 3 R's, there are probably 2 R's in the market. Those are the defining investors. But I'm happy to be in that company.
Yeah. No. And as per some of our talks, which we'll get into, I think whether it's learnings from them that you mentioned or however you carry forward what you three had sort of figured out in the last 3 decades and you share it with all of us. So I think that's helped. Another way to put it is the way we have Warren Buffett and Charlie Munger of US, you three were that of India.
You keep being very kind to me, but thank you.
So let's just quickly start with a basic introduction to your journey, right? I know. So surprisingly, all 3 of us were students of HR college.
Right. How about that?
And you, I think in the 70s, you went to the California State University?
Correct.
For your
Yes.
MBA?
I date myself, but yes, in the late 70s, I graduated from HR college like you all did, but probably a few decades later. And then I went to California and did another bachelor's and a master's from there.
Okay, bachelor's and master's.
Yes.
Okay. So let's just start with that. So how has your initial education sort of impacted your career when you look at it in hindsight?
There are many ways, but when I went to America in the 70s, I was, almost a socialist. I think it was very fashionable to be Gandhian at that time and believe in socialism. I think most young people believe in that equality. It's only when I went to America, it kind of opened my eyes and you realize that incentive is a very important and driving, motivating force. And it's not necessarily an evil to build capital and to get wealthy. I think America really helped me because there are wide open spaces and I was right in Los Angeles, which is the center of Hollywood, the tech industry, the sporting franchise and so many good things out there. So it kind of opened my eyes and realized that, to be successful is actually a good thing and that if you're successful, you can take a whole team along with you. So I think more than anything else, more than the education, more than the degree, it was the opening of my eyes in California to what a successful person is and that wealth can be used for very good uses too. And I learned that all in America.
Awesome. And then you worked in America for a while?
Yeah, I did. I graduated in 1980 and I started working in the tech industry, which is crazy to think about it because I was one of the first guys from the tech industry out there. Though I wasn't working from India, I was working as a US tech player. And there was one lesson that I learned when I came back is, what Steve Jobs says, how your life connects at different points in time. And my life connected because as you'll find out later on that what I learned in the technology business in America really helped me in the investing business in India. And that sounds amazing, but it was true.
And then, so you came back to India in the late 80s?
I came back to India in late 80s because I was the only son, and there's a lot of pressure from the family to come back. He said, "You've had your fun, come back." But to be honest, my father was also in the stock market at that time. In one of his weaker moments, he told me that if he had the longevity of career at that time that I had, he would buy equity in India and throw away the key. Therefore, there were only physical shares at that time. That's what he meant. To buy the physical shares, keep it in a locker, and throw away the key. You don't want to sell it because he was that bullish over the next few years. And he'd been watching the market very closely for the previous 2 decades, So he had this insight, I guess, just watching the market, that India was on the edge of a boom. I was not particularly happy to come back to India at that time because it was the very rare person that migrated back from Los Angeles to the suburbs of Mumbai. But I did that, and I have to say it's been a happy story.
Yeah, last time I remember when we had mentioned this point that the advantage you had being your father's son was that this time in your generation you could actually invest for the long term rather than just invest to make your day-to-day, year-on-year ends meet. And that was the advantage you had, that you could take a longer term view on this.
That's absolutely true, and it's a very interesting point. And there are 2 truths to it. The first truth, as you said, is because my father already established a basic level of income, it was then easy for me to look at the long run, which probably wasn't easy for him. But also, India gave you that opportunity to invest for the long term, which perhaps you weren't aware. So my father was more interested in buying and selling shares, making the long-term capital gains. But I, very early in my career, was introduced to a very veteran investor called Chandrakant Sampath. And he kind of told us about the values of compounding. And at that time, it was a bit of a disbelief in what he said. But having put that into practice, I realized that's probably the first lesson that every aspiring investor should learn. The fact that India, when I joined, the index was below 1,000, the Sensex was below 1,000. Today, it's over 65,000 or so. So the long-term trajectory has been absolutely brilliant in the Indian stock market. And to add to that point, if he had told me in '89, when I started my career, that over the next 30 years, India would face a financial crisis, pledge gold to the IMF, go to Kargil, have a global financial crisis, have a plague in Surat. I mean, n number of things. I probably wouldn't have come back. But here it is, we've been through all these various items, and yet the index is almost 60x from where we started. So it's a tremendous lesson to understand of how markets work.
Super. So let's just jump into the second half of your journey with slightly more detailed questions.
So one of the things which I want to touch upon is failure very early on. Why I'm speaking about failure is because we have a lot of students who are giving competitive examinations, they're failing, they're also passing, but failure is something, how do you deal with? And your dad gave you $10,000, if I'm not wrong, and he said, go ahead and invest in the markets. And you famously, I'm assuming, did not make that into, that did not convert into a profit at that point of time. So how do you deal with that, and what transpired that, because a lot of new age people, especially right now, you're seeing, especially with movies like shows like Scam 92, which has come out, a lot of people want to invest in the markets, but they don't know how to.
Yeah, these are multi-part questions. First, to deal with the failure part, you're absolutely right in the synopsis of the story you mentioned that my first flirtation with the equity market was in failure. He sent me $10,000. It's a big amount for him. It's not that it was a small amount. And I managed to lose a large portion of it in a bull market, which of course frustrated me no end, because how do you go bankrupt in a bull market? And I proved you could do that, The lesson I learned was that when I was driving, I was looking at the rear view mirror, not at the front view mirror. What do I mean by that? In the 1980s, what had worked in the 70s with all the inflation stocks, gold, commodities. So they're down 70, 80%. So I thought they're good bargains now because they're down 70, 80%, and I bought them. And they fell 70, 80% from that price also.
Oh.
Instead of buying the stocks, the growth stocks that were, the technology stocks that were doing so well in America. So I learned now in retrospect, it's a very inexpensive education, that you want to buy things by looking ahead. You don't want to drive by looking at the back of the windshield. How do you start in the markets? I think a lot of people will make mistakes, and it's okay when you're young to be wrong, and then right. Rather than be right, and wrong, because you have a lot more to lose at the end of your career than at the beginning of the career. So, I think try and evolve a philosophy that you believe in over a period of time. The trouble is there are a lot of competing philosophies in the market, that people who do arbitrage, people who will concentrate, people who will diversify. I think you have to figure out what jacket fits you the best and probably stick to that. But the one jacket that I know that everyone should have or should wear is understanding compounding, because that's the key to creating wealth. I think if you want a very quick, rich scheme, stock market is probably not the place for you to go. You probably need to marry rich. You probably need to, inherit a lot of money.
Vegas.
Yeah, go to Vegas. There you go. But if you, as you mentioned in your introduction to me, that if you compound your money at 20 to 23%, which is doubling your money every 3 years, over a 30-year career, you can grow from 10 lakhs to 100 crores.
Right.
So it doesn't take a lot of money to become rich.
Right.
But the trick to becoming rich is compounding. Really, you have to be able to compound your money, move it, and look at the stats. The Sensex moves up about 16-17% a year long term. Add a couple of points for dividend. So doing 17-18% anyway. Now you add a couple of points for your stock selection, and you're 21-22%. There you are. So
It sounds
that's the
way
trick.
more- You're making it sound too simple. But if I'm assuming I'm starting in the markets for the first time, what would you tell me the 3 mistakes not to do?
But first, I'll tell you one more point before I tell you what not to do. I asked one of the wisest investors I've known in my career in India, and he's made money in the last 4 decades in all bull markets, whether it was the cement bull market, the tech bull market, the real estate bull market, whatever bull market. He's always been ahead, always had his nose above the water. And I asked him which is the best decade that he had in investing. Was it the 80s? Was it the 90s? Was it 2000? Was it today? And without missing a beat, he said, tomorrow. Yeah, the next 20 years will be as exciting. And here's a point that I want to make sure that your investors understand, that a lot of them will feel, and perhaps rightly so, that, it's nice for you to preach, but you were lucky, you got to India in 1990 and the index went from 1,000 to 60,000. We're not going to get as kind of returns as perhaps you guys enjoyed over the last 30 years or so. And I think with all my belief, I'd like to say that I wish I was 30 again with the wisdom I have, but you take the money, but give me the wisdom and give me the youth. And I think we'll be able to replicate that money back, because opportunities in the next 20, 30 years in India are going to be as exciting as they were perhaps in the last 30 years, perhaps even more exciting. So the first thing is to be, understand compounding. The other thing is to be bullish on India. I think one thing I learned from my mentors is that no matter what happened in India, no matter what crisis happened in India, they believe that India was bullish and is going to remain bullish. What do I mean by that? They knew that, for example, when we started in India, the income tax rate was 90%, 95%. There was wealth tax. There was licensing for everything. And they realized that all that had to change, and change for the better. The democracy would demand answers, that people would demand a higher standard of living. And the 90% taxes, they almost predicted it would come down.
Yeah.
So they believed that the trajectory was only one way north. In between that trajectory, you would have volatility in the asset class, volatility in markets, and that's happened. But then they use every dip as a buying opportunity. Okay. And while they might have been bearish at times and bullish at times in terms of the stock market, the way they would appear to the stock market, they're always long-term bullish on India. Okay. So the other thing I would always suggest to India is that, there are times when the markets will be overbought, times when the market will be overvalued, and you have to be very careful at that time, but be long-term bullish.
So the prolific investor who told you that, listen, I'm going to look at the next 25 years, is no one but Mr. Rakesh Damani. Is that
You're absolutely right. He is my namesake when you very favorably compared him to me, but I think he's in a class of his own. I think he's probably India's, he's probably the Steve Jobs of India. The reason I say that is because not only is he a good trader and investor, but he's also now proved himself to be an entrepreneur by creating one of India's finest retailing companies. So luckily for me, he's my friend, and I've heard, it's like I always tell people, like, suppose you were in America and the first week you met Warren Buffett and Charlie Munger and Peter Lynch. Yeah. You would think that everyone is Warren Buffett, Charlie Munger, Peter Lynch. The first few weeks I was in India, I met Chandrakant Sampath, I met R.K. Damani, I met Rakesh Jhunjhunwala, I met Durgesh Bhai. I met so many of these wise people. So, forgive me for thinking that everyone's a good investor, but, I got lucky.
I didn't mean to meet people like...
We do, I think everyone can spend some time with them.
It's
all
more about
blessed.
having great mentors, though.
Huh?
And you're fortunate enough to have great mentors.
Absolutely, there's no question about it. I mean, if someone tells me I've seen further, it's because I stood on the shoulders of giants, as Einstein said. And I've been very lucky. They were my friends, and they influenced me in so many ways in terms of how to approach markets, how to think about markets, how to be bullish in India long term, how to understand what returns are and what risk is in the stock market. So I think I've been very blessed, and I would always say this to the generation to come, that the opportunity is still there. Yeah. It's not that because you got to 60,000, we've peaked out. The opportunity is still there. But you have to learn to be long-term bullish. You have to think in terms of your career over the next 10, 20, 30 years. You try and do this over the next 1 year or 2 years, you're going to get frustrated, you're going to lose money, and you're going to go through periods where you say, I don't want to be in the stock market. And that would probably be wrong.
So, sir, in this on the same lines, right? You mentioned two of the most, again, famous investors, at least, is Rakesh Jhunjhunwala and RK Damani. And like you said, from your early days, you've been in some form associated with them. You sort of met them in the first few weeks or when you started the investment journey.
Yeah.
I think we would love to hear a little about your stories with them, your journeys with them, maybe some of the learnings or the mistakes. But if you can just, I think this is a story that many people don't know, but I think everyone will be really interested in hearing this story.
You know, I as I told you, I met them in the first few weeks. I met Rakesh actually on the ring of the Bombay Stock Exchange. RK Damani was known to my dad, and he kind of introduced me, and I immediately grasped that I was dealing with a superior intellect in the market, because the thing about RK Damani that most people don't know is that he's actually one of the world's great listeners. He is truly terrific. Most people want to impress other people with their opinions, their thoughts, their words. But RK Damani never wants to impress people. He wants to listen to people, you know. And he knows what to listen to what person. He's figured you out, and he says, this guy is a good speculator, this guy is a good investor, this guy is a good investor in FMCG stocks, or this guy is no good. But he knows how to categorize and listen, and he will play those hunches. And I think, as your namesake in your company, Zell, said, you know, that sometimes in the markets you have to pull the trigger in order to make money. So you can have all the views you want, but he knows how to pull the trigger when the time is right out there. So it's almost unparalleled in terms of his sense. And I watched him all the way. I think he left the market sometime around 22,000 on the index when 2008, and then he moved to retail out there. And he must have been to 3-4 bull markets and bear markets out there. And astonishingly, I don't think he missed the top of either one top of a bull market or the bottom of a bear market. He's that good. He could figure out all this. With Rakesh, of course, who also considers RK his mentor in many ways. They were competitors also. They were mentors also. Rakesh, always bullish on India. Both of them, always bullish on India. That's the basic fundamental DNA that they both had. Two, they were ready to put money on the table. If they had an idea, they want to put money on the table. They didn't want to think as a thought process. They're always ready to put money on the table, and that was distinguished them in many ways. But Rakesh also brought a lot of courage. He was a middle class, poor, lower middle class guy, son of an income tax officer. But, you know, he was, you know, almost fearless. And if he was convinced about an idea, he didn't care. He wanted to put his money and be there. So, I mean, a lot of work has been done since Rakesh unfortunately passed away early. And I think his compounding rate is probably the best in the world. That's really, and this is in dollar terms. He's probably compounded. He started famously, as he said, with 5,000 rupees and bought, I think, Tata Power first, because the dividend yield was greater than the interest he was paying. And he parlayed that into $20-30 billion, which gives a CAGR of 40% plus in dollar terms. You know, I mean, Warren Buffett is, you know, idealized the world over for, you know, doing 18-20% compounded over 30-40 years. He didn't live long enough, but I think he would have had probably a better rate of compounding. So I'm very, very lucky I got to know them and got to learn almost firsthand from them.
Yeah, that's because I very recently spoke to somebody who was saying that since Rakesh sir passed away, his portfolio has almost again doubled. And in the pandemic also, there was a massive surge in his portfolio. So in the last few years itself, he's also tripled or quadrupled what he has already done for so long?
I'm not sure about the tripling or quadrupling. His portfolio has done very well from a year-to-year basis since he's passed away, because we know the stocks that is owned publicly, so we can understand Titan going up or Crystal going up, and that's added to his portfolio. He's done well. He's also made a lot of very acute bets in the private equity space. For example, ACCA Air, Concord Biotech, all these shares, which have also done very well for himself. So I think he's been almost like an investor with a Midas touch. You know, it's like, you know, knowing Buffett and Munger at the same time, knowing RK and Rakesh was, you know, almost like that feeling for me. And in retrospect and look back, I'm in awe of their accomplishments. You know, as you very kindly suggested, 3 hours. You know, I would respectfully suggest you they're 2 hours actually.
And answer last question for RK sir is. You saw one of the best investors in India also turn an entrepreneur and really break records even with DMart. So how was that, if as a spectator of his journey, how did, you know, to see somebody being a stalwart in finance and then business, How was that?
It's almost unfathomable. I mean, at that time, I guess to humor me, he asked me what should he be doing. He was considering a career in retail and considering a career in the stock market. I think to humor me, nothing else. He was already made up his mind. And I said, no, you stick to stocks. I mean, you're so good. You're the best in the business. Why do you want to give this up? So we couldn't really understand his dream of setting up a retail empire. But, he knew best. I think he realized that, a well-run company, a promoter, can get an extraordinary market cap, but investments can only buy 1%, 5%, 10% of a company, not more than that. So he wanted to own a big chunk of the company. And what many people don't realize is that DMart in his journey started, say, in 2000, went public, say, in 2017, 17 years. In all the 17 years, he never diluted his equity. He must have had plenty of opportunities in VC, private equity funds, friends who diluted equity. Not once did he dilute his equity because he knew the value of the equity. And he diluted only the minimum necessary required by the statutory authority. And here's some other part which you don't know about the man. Before he went IPO, he took a list of his best friends and he gave them all shares, basically at par value, because he wanted them to own it.
Yeah.
And a lot has been said in the popular press about Clooney giving shares to his friends, a few $100,000. The shares that he gave were worth much more than that. And he gave them gratis because he knew them. It's an extraordinary amount of generosity. He did not dilute to private equity, he did not dilute to a venture fund, but he gave it to his friends just before the IPO. Right. And even today, he holds the entire equity that is legally allowed to, which is about 75%. My feeling is that he's in no hurry to dilute that equity. Right. Despite the enormous valuation, the enormous temptation that you got for so many times. So it's an extraordinary journey to see someone who is so skilled as an investor, as a speculator, leaving that aside, and he left that aside, maybe invested on the side, but becoming a full-time entrepreneur, working in the stock shelf, stocking groceries, purchasing, ordering, traveling. Extraordinary accomplishment. I think he started, if I'm not mistaken, he must have started this when he was 40, 45. So even at that relatively ripe age, in the next 20 years, he's built a world-class business for himself among the top 50 companies in India. So extraordinary.
Absolutely. I remember I've met him a couple of times and he's just the most down-to-earth, humble, always smiling. You don't realize you're in the presence of somebody who's accomplished so much till you actually converse with him.
Yeah, absolutely. Absolutely true. It's and I think his entire friend circle, while we are friends and we're peers and we're partners and we always rib him a little bit here and there, but we always realize that we're in the presence of greatness.
Yeah. And so one last question on DMart before we move ahead. So you've been the chairman for DMart since?
The last 10 years.
Last 10 years. And just if you can share your views and journey of that.
Yeah, why is DMart split the norm?
Yeah, I have to be very careful because there's only, I'm the current chairman of DMart, so I have to be very careful about what I speak. But I think what they try to do is offer, good value to customers. I think they were one of the first companies in India who realized that if you give customers below MRP, they would do it, and they worked out their relationship with the vendors and everybody else to do that. It just runs a well-oiled machine. I think the two things that really helped them is that they never went to venture capital funds, so they never really had the pressure of performing. So they grew as they grew. And I think what is commonly known is that they own the real estate. So they're always very patient. Once you rent real estate, almost 10% of your top line goes up in rent. So it's a tough margin business anyway. So I think those were some of the strategies that they used to become successful.
Very similar, if I can even say this, and I'm happy to remove the question if required, but is it similar to the Costco model?
I think Costco is, leaves a lot to be admired.
Yeah.
I think they have a phenomenal model. And if you actually go through I don't remember the numbers exactly, but if you go through the numbers, Costco makes money only on the membership fee charge. So what are the number of members times $75 is what they make. So they basically, it's a cost business and they make it through this thing. So we're not there. We don't always charge a membership fee, and obviously we're not even remotely as big as Costco is, But Costco is probably one of the more worthy retailers around.
Yeah. So, a few questions around, we spoke a little bit about failure earlier. I want to ask you, there was a next jump when you came back in the markets. You got 10 lakh rupees, which you converted very famously to 100 crores. That whole story. You tell us a little bit about that because it happened with you. You're not.
No, I think that was just to explain a point. But let me explain to you some of the things that worked with me and connect back to the earlier part of the introduction out there. I told you earlier in my story that I started work as a technology guy, not interested in the stock market. I lost 10,000. I got interested why I'd lost the money. And now I come back to India and I'm here, first dealing with in 88, 89. And there's a big cement boom going on in this country at that time. The so-called Harshad Mehta bull market was unfolding out there. And I was amazed. I was an MBA student from America, well-read, and I couldn't name a cement company in America. I just could not name it. Nothing came to mind. And yet, even my lowly jobber in my office or the lowly panwala or anyone else would know the price of cement at Raipur or price of cement in Bhopal. I mean, everyone was so well. I said, how am I going to compete? Everyone is so well informed out there. Little realizing that we were in the middle of a bubble in cement, So cement went up 10,000, then, folded out there. So I was right in the middle of the bubble and realized that at always the peak of any asset cycle, there's always so much interest about it, whatever. But cut a long story short, I realized this after many years is that how your life connects. Like I told you, in a previous lifetime, I was working as a techie. And I realized very early on that what I was charging, maybe $100, $125 an hour in America, you're getting programmers to do it for $5, $10 in India out there. And so when I came back to India, luckily in 1993, right after the cement boom bust, a company called Infosys went public. And I realized the value of the business. I didn't care that they didn't have any assets. People thought there's only people, there's no assets, what I'm buying, no gross block buying, someone has book value. But I realized there was almost unlimited business out there. Made a very small investment in Infosys, and that turned out to be one of the most lucrative investments of my life, up a few thousand X in that time. So that turned out good. But that also opened the doors to me because I bought CMC, maybe the other tech companies out there. So there was a company called CMC, which was a public sector unit. Your listeners might recall that in 1980s under the George Fernandez government, they had thrown IBM out of the country because they said either dilute your equity or you get out of the country. So they left behind. But there was a computer that had to be serviced, not the railways, but universities, government has computer power. So the government created a company called CMC or Computer Maintenance Corporation to service that out there. And they happened to be when I coming here, I realized they happened to do the Indian railway system. So I realized it was a very complex system. The Indian Railways is 6,000 stations. I mean, up to a number of few crore passengers traveling a year. A very complicated thing. And yet they did online real time trying to change it out there. So in 89, when I came back to India, I just happened to realize that the board system which we use, the trading system, the engine was designed by CMC. And then this company got listed. I got listed for some market cap of maybe 50 crores or 40 crores or some. And it just astonished me because I know if suppose you do a trading system, it probably costs you $100 million for IBM to do it. And here getting this entire company.
That also cost them $100 million to do it.
At least it was such a complicated system. Imagine a trading system connecting India live, real time. You can't get wrong out there. It would cost you a fortune to get that kind of software done especially at that time, because programming talent wasn't that widely available, And here I was getting this company for me $4 or $5 million US at that time, So we bought a lot of CMC at that time. So Infosys and CMC were the two early pillars of my career that, got me that money. And then it was, of course, reinvesting that money. But basically, it came down to compounding. Those helped me compound my money and then moved on to another bunch of stocks after that.
We're going to speak a little bit more about compounding a little later. But the Infosys CMC story again, of course, it continued. But you still hold those stocks?
Do I still hold those stocks? Well, see, this is what happened. Infosys, I sold out around the peak of 2000. Not right at the peak, but just below the peak, I sold out there. CMC also I sold, but I kept some of it. And that ultimately got merged with TCS. And I think some other eServe or something like that. So they got back. So still in a manner we hold it. CMC, of course, no longer listed. Infosys is still listed. Infosys, I think generates, I did a study once that maybe on that, if you had that original 1,000 shares, which I had, if you keep compounding, you have maybe, 1 lakh shares right now. And you're paying maybe 20 lakhs a year as dividend, which I bought for 2 lakh rupees. Say, if you bought 1,000 shares, you pay 2 lakh rupees for it. And you get 20, 25 lakhs as dividend per year on that holding, So it's been an extraordinary wealth created in India.
Like Infosys, Wipro has been one of the companies which has created enormous wealth. They say that if you had invested in the IPO in Wipro, you got one lot, which is 10,000 rupees. That would have been north of 700 crores.
Yeah, it probably is. I think I've done the math. It's extraordinary how many great companies have been created in India, or how under-researched India was. You could have bought Cipla, you could have bought, Dr. Reddy's. You could have bought so many of these companies, and they've gone up 100x, 200x, 500x. And the beauty is that they still look like they can double. So that's the extraordinary amount of...
Started, right? We've overcome most of the problems we could have to overcome. We're in the growth phase at this point of time. I mean, if we look at China, or what China did 30 years ago, do you think we could, I mean, obviously we can learn from their mistakes, but do you think we're right now in the fastest growing pace than we could ever be?
Probably, I think, China is a wrong example because they're very poor capital allocators. The stock market hasn't done well. The companies have done well. The infrastructure has done beautifully well out there. But India, we've had good companies with good return on capital, good management class created, which has created wealth for shareholders and wealth for the economy as a whole. I don't think the Chinese stock market has created that much wealth out there.
So I went there for China as an economy.
I think that'd be great if you can follow China as an economy and create that kind of infrastructure, create that kind of business.
Yes.
We probably will never be as good a manufacturing power as them, but we could be a good service power. Could be a great domestic economy. I think we're definitely on that journey.
So in these lines, right, you mentioned your journey of how you sort of stumbled upon the tech industry when you started. As you matured, your investment philosophy, right? Just wanted to sort of, and maybe for viewers who are looking for this kind of insights. Right? So the very famous quote that would you buy a company, a wonderful company at a fair valuation, or a fair company at a wonderful valuation, right? Basically between value stocks and growth stocks. What is your take on that for the Indian companies?
Well, I think I'm just listening to the debate even today. Am I a value investor? Am I a growth investor? Am I a momentum investor? Whatever. I'm a value investor. Let's get that clear. But growth is a component of value. I mean, that is what you look for. If you look for a company that's growing, that's part of the value you're getting in the business. So that's why I think value encompasses everything. It's like my mother always told me when I went shopping that rupee ki cheez chamani mein kharidne ka apne ko. You want to buy things cheap. So you want to buy stocks cheap. Let me give you an example. Again, this is well known in my career, but it serves a purpose to understand. I'll give you a couple of examples. After we bought out of those tech stocks out there, I started looking at the FMCG industry, and everything is pretty expensive out there. Lever trading at 60 times earnings, Colgate trading at 75 times earnings, whatever. So there's no real great bargains. And I always had the mindset to look for the X thing, something can go up 10x, 20x. I was never happy because I was an individual investor. If you told me you could make 20% in this over a year in that particular stock, it really would interest me because I realized that if you could make 20, you could lose 20% also. They're typically, I want to look for things where I couldn't lose a lot of money, but if I'm right, I would make a lot of money. So those are a bit more harder, but you train your mind to think for that rather than try and look for those 20, 30%, which people are fine doing, but I'm not fine doing it. I'm looking for those low risk, high return type of situation. The price you pay there is an opportunity cost. Sometimes if you're wrong, it doesn't move for a long period of time. So you won't make any return. But it's very unlikely to lose serious amounts of money in those, right? And if you're right and the triggers happen, they will move up. So I'll give you two examples just so that it interests your viewers as to how this process moves. In the 2000, I looked at the FMCG industry, I was saying, I'm finding everything expensive. Then we found this Indian spirits industry, the Indian liquor industry, they were a few hundred crores. And here you're getting 50% of India's liquor market, 50% of India's beer market, for maybe $200 million US. I mean, that's ridiculous when you think about it. A country of 1.4 billion people, the majority below 21 years of age, so coming into drinking age, each year a few crore people coming into drinking age out there. Great brands, established brand names, and you're getting those so cheap out there. But everyone told me and discouraged me saying that, well, these stocks don't work. But as Sam Zell once said that when everyone goes right, you want to go left. So we made a bet on that. And luckily there was a bit of human psychology inside out there. Everyone was bearish on, the owners that promoted the company, who I don't want to mention because he's in hard times now, but I don't want to mention his name, but leave that aside. At that time, he was one of the biggest, larger than life figures in India. And I kind of figured out that the guy with such a big ego, market cap of the tech guys, that there was a puny, and he would do something about it. And that ultimately what happened, he decided to extract value. And once he decided to do it, value gushed out from these shares. So these stocks had 50x, 100 mooks over a period of time, which kind of reinforced my theory that you want to buy with low risk and high return. Okay. Now, the company was at that time at $40 or something, McDowell's and UB Beer, just to put a name on them. I'm not recommending them anyway. You were getting a 5% yield, a dividend yield of $2 per share. So, you knew you couldn't lose much money. How much are you going to lose at, at 200 crore market cap for these companies, Right. And luckily there was a trigger when the promoter realized that he's become a small fish in a big pond. is not going to work for him. So that changed. So that happened out there. So you cut forward to a lot of, there's been a lot of hatred for whatever reason for the public sector stocks in India. So in this recent round, to be more contemporary, we managed to buy a lot of these public sector stocks, and people ask me why I'm buying them because they haven't performed for the last 10 years. I said first value is, your mother told you, rupee cheez, 10 paise lena, rupee cheez. They're all, if you look through the balance sheet, they're trading at cash values, they're trading at 8% dividend yields. They're trading, at basically they were throwing away the defense and the real PSUs out there. And my son came up with this idea as we were going through it together, and that's been one of the joys of my last life that I woke up with my son now. So we, he's kind of expanding my horizons rather than the other way around. So he told me that I can't believe that all your friends, and this is my entire stock market, is so bullish on the BJP government and so bullish on the prospects of India. But they're not bullish on the companies that Mr. Modi is running. Yeah. I mean, if he's a good manager, good corporate governance, this company should improve. And that was the trigger really that came about. I don't know if all of you saw when the Prime Minister came on Parliament and said the public sector stocks are undervalued and then you should buy them. And so we bought a lot of them, and, triggers happened, good things happened. They were so cheap. And the Buffett has often said that in the long run, the market is a weighing machine, not a popularity machine. So it didn't matter that they were not popular, but they were good, solid companies with good order books, good cash flows, and they started performing for a period of time. So over the years, my philosophy by default has been to find those low risk, high return, what I give up in terms of performance in terms of time. Sometimes they take a year, 2 years, 3 years before they start performing. But when they're performing, they make up for the time. So coming back to the point that is so important to me is to get the CAGR right, to get the compounding right. If they double every 3 years, I'm fine. If they double in the third year, not in the first two, that's okay with me too. Yeah. So broadly, we try to do that.
And you've been quite I don't know if this is a recent past since this story or even before that, but you've been quite, again, bullish on Indian public sector stocks. Is that right?
Yeah, that's what I just mentioned. Absolutely.
Okay. And if I take a step back from equity, right? Because whenever I have ever come across anything of, whether it's content or videos of yours, it's always on the equity bit. Just wanted to take a slight detour and ask you that beyond equity, do you personally look at investing in components like debt?
I'm almost, I don't know how to say this without embarrassing myself, 99% in equities always.
Okay,
we never buy debt, rarely have fixed deposits, if any. The jewelry, the real estate is all meaningless. If my wife wants it, you get it. I don't really care about it. I don't even know about it. It's in equity or waiting to be invested in equity. I mean, that's basically the two buckets. I even detest keeping in FD the balances that I have after selling something, because if I get used to the interest, I won't go to invest in equity. But occasionally I do get into cash, but it's all my career, it's been basically in equity.
The stock which you spoke about, and I know you mentioned this publicly as I'm speaking about this, it was Bharat Electron. Yeah. So that went on a rage, if I'm not wrong, but can you tell me a top 3 stock picks and how much have they made in terms of percentage return, in terms of absolute value, whatever you'd like to?
Well, I made almost 50-100x my money in those liquor stocks.
Yeah.
I made, 2,000 times my money in stocks like Infosys. I mean, this might surprise people. Infosys went public in 93, I think in March 93 or something. It went public. It went public at a market cap of 30 crore rupees. 30 crore rupees is the market cap. There was a 3 crore equity, 100 rupee price, 30 crore market cap. It went public today. I don't know, maybe 5-7 lakh crores, something in that nature. I must have sold it a few lakh crores market cap. So I made enormous amounts of money out there. So that has been there. And a lot of these PSU stocks that I bought recently may not have gone up 50, 100x, but they got up 10, 20x, which is, pretty good going. So I can't complain. But it doesn't really matter, because here's the point they try to impress on a lot of young people come to me because I enjoy meeting them, and, we enjoy going out together, and, they keep me also motivated. So I tell them, the way you have to look at yourself is you have to double your money every 3 years. Yeah. And if you're doing that, you're doing the right thing. Whatever you're doing, keep following that. You don't have to worry about it. Because if you double your money every 3 years, you're going to be 1,000x richer by the end of 30-year period out there. So I try and encourage them to do that, as long as, suppose you're not doing it. Suppose you not perform for 5 years or 6 years, then you better change your tack. Yeah. Realize that what you're doing is not working for you. So a lot of people say, I prefer speculation, I prefer trading. I said, fine. As long as you're doubling your money every 3 years, keep doing that. I'm not going to stop you from doing that.
So, since you're speaking about doubling money every 3 years, you're essentially getting compounding some of the other way in the picture. Can you tell us your famous compounding story? Would you explain How do you go from 10 lakhs to 100 crores? A little bit more in detail.
Yeah, there are some great businesses that I've held for 20, 30 years.
You still have those?
I still have those businesses for 20, 30 years. I'll give you a name, Sundaram Finance. Again, I'm not recommending the stock. Stock underperformed long period of time and Bajaj Finance is doing well. But, it's overall, it's been decent stock. I've had Trent. I've had number of stocks that, KSP Pump, Vesuvius, which I've kept in a portfolio. Now, sometimes they don't compound at 20 to 23% because they become larger size. So they compound at 17, 18%. But because we bought them cheap, it remains that. So here's the trick. Here's the trick that everyone needs to understand. The stock market is not a get-rich-quick place.
Yeah.
People think that and people like to believe that.
Yeah.
Maybe what they see in movies and, they think that's what happens. But it doesn't really happen, If lightning doesn't really strike you, and if it does strike you, it's going to take it away from you too, okay? But it's almost an extraordinary place to get rich slowly. As long as you're willing to spend 30 years doing that in your career, you can get there. So here's my 2 suggestions to you. If you are, say, a lawyer, or say you are a metallurgist, or whatever, and you're doing a business, you're busy in that, making a living, please by all means do that. If you have extraordinary money or extra money to invest, and you don't know how to invest, put it in an index fund. That's very simple. The index goes from 1,000 to 50,000, you make 50x your money. Nothing like that. That is what I suggest. But if you are interested in capital allocation, you're interested in markets, then you need to do some more work and come up with your own ideas of where you want to invest. While you will get decently well-to-do while investing in index fund, if you really want to get rich, you need to invest directly in equity. I always wanted not necessarily get rich. That was a byproduct, be financially free. I didn't want to have, to be looking around for people when my kids were growing up and my parents were old. I want to make sure that they were well provided for. And I think equity markets investing directly in India gave you that opportunity. And that opportunity is as open for the next 20 years as it was for the last 20. So, it's a great way to begin. And it's one thing I urge almost every lecture that I give or every talk that I give to people is understanding how compounding works. It's almost a magical process that if you can move your money at 20, 21% a year or double it every 3 years, what you end up with at the end of 30 years. It's almost like
10 goes to 20 in 3 years, 20 goes to 40 in 3 years, 40 goes to 80 in 3 years, and basically it keeps...
I mean, you actually do the math. You do put it on an Excel spreadsheet and move it up, doubling every 3 years, and you go up 1000x in a period of 30 years. In a period of 30 years, it doesn't matter what you start with. You could start with 10 lakhs, you could start with, 25 lakhs. It doesn't matter. You're going to be fairly rich at the end of the process of that. Now, have I seen 30 years? Now, what is the corollary to that? The corollary to that, which I tell young people, is that when you're young, invest in appreciating assets, not depreciating assets. When my own son went to college, I gave him a choice of investing, 1,000 shares of the liquor companies I mentioned about, or buying a cell phone, which was about 40,000 rupees or something in that nature out there. And of course, he picked the cell phone because he's young. And over years, I explained to him the difference that is made because that stock kept going up, and the cell phone, of course, is now on his 10th cell phone probably, So he buys one every Apple iteration. So he doesn't necessarily buy what Dad says, but leave that aside. I mean, another friend of mine gave my son
shares,
of HDFC Bank. And what a great compounder that's been. And he kind of learned the lesson in life that, you want to invest in appreciating assets and not in depreciating assets. So, sure, you need a car, you need to go on vacation, you need to buy clothes. I understand all that, but try and save. It's so important when you're young to save because the money will return bountifully to you back in your old age. So people always say, I have to live, I have to do this, so I don't care, I need a vacation. I'm sure you do, and nothing wrong with it. But if you want to be financially free, do you want to be running around at 60 trying to make another 1 lakh rupees? Or do you want to have the dividends roll in and the capital appreciation take care of your financial issues? I think a lot of people would prefer the latter.
You mentioned index funds, right? Is it right to think that for those who cannot be actively involved in the markets, it can be probably the best option for them?
Yeah, I think so, because if you're not actively involved in the market, and I find a lot of these schemes that, PMS schemes, for example, not to pick on them, but they charge you 2% every year. It's a bit extortionary in my view, 2% is a fortune compounded over 30 years, So I don't think you're going to get terribly rich. A lot of them underperform the market anyway. And plus you pay 2%. Over 30 years, you lose half your capital by paying 2%. You don't want to do that. So invest index, low-cost index fund.
Can you just explain to all of us, in your way, how do you look, what is an index fund basically?
Index fund mimics an index. So, for example, if you had come to India and I'd come in 89, the index was say 1,000. The BSE Sensex was 1,000. You bought all the components of the index.
Right.
And so you would have a replicate of the index.
Right.
Now, if the index went from 1,000 to 25,000 in 2008, your wealth would also go on 25x, minus some tracking error of buying and selling. So basically, it seeks to replicate index and keeps it honest with the index. What they do in index, of course, they remove all the bad stocks, the Baroda Rayons and the IOCs of the world that didn't perform. They remove and replace it with the Infosys and Ciplas of the world. So they do all this cheating. So in that sense, it's good. You pay a small amount as tracking fee, but nothing as extraordinary as 2% a year. Right. So my feeling is that a lot of people who don't have the time or the bandwidth or don't want to pay this 2% are probably good in putting in an index fund, which is very passive. But there are people like me who live on capital allocation, who want to do active allocation on there, okay? So with active allocation, you better trust the people you're doing and have a sense of faith or belief in that business.
I want to ask you one question because you spoke about capital allocation. When you were 30 years old, or when you were 25 years old, how if you had 100 rupees, how would you allocate it a little bit for your expenses? But the other money which is there, you save some, invest some. When you're 25, you said, I'm going to.
My wife I was always invested. My wife would famously tell me that I can't live in the Sensex, Ramesh. I need a sofa. I need. I would always try to tell her that why would you want learning from my mentor Jim Rogers at one time. So why would you want all these things when they're going to depreciate to zero? When they can invest for you. Are you only smart? Do you only understand this thing? Everyone buys a sofa, a house, or a vacation and said, I don't know if I'm smart, but I want to do this.
There's a lot of noise which is happening now about banks being an investment. Luxury banks.
Yeah, I know. I mean, they will make any asset class that goes up in pricing a good investment, but you need also liquidity for investment. You need a good liquidity. You need to put in size in investment. Yeah, the banks, there's all, chicken.
So early days, you will say, save as much as you can and pump it into investments. Or keep a slight thing for a rainy day or, there's a very famous concept that don't put all your money into the market or investments. Keep 20% for probably, and again, look, not every investor might be as savvy or into it as for larger parts of the population, better than 20% of us when they make it. Maybe there's a time which will come in.
Maybe, but I want to get rich. See, I realized that I'm going to put in FD is not going to make me rich. Yeah. So I wanted to get rich. So I knew I had to put it in the market to give me that chance to get rich. Maybe it would go down and it wouldn't work out there. But that underlying belief you had, and we've kept this through highs and lows, and people say asset allocation, okay, I'm now 65, so people say put 30% in fixed deposits, 60% equity or the reverse, or whatever. But I've never done that because, you want to put in equity, you want to get rich out there. And I think risk comes from not knowing what you're doing, and we spread 24/7 in the market. So, we kind of more familiar with that.
Also, Warren Buffett made majority of his money after 65, I'm not.
Yeah, he did. I mean, he made, I think, after 50 was worth $1 billion, and after that he became, 75 billion or something like that. So,
you think if Rakesh Jhunjhunwala would have continued for the next 30 years, he would have surpassed that?
I think he had a shot at it, definitely, because he was bullish on India, he was a good investor, and he had done very well for 20, 30 years. Could he do well for another 20 years? I think there's a good shot he would be able to. Size creates its own problem, but he would have. He was fearless and stoic. I mean, the thing about Rakesh that really impressed me is that in the last year of his life, when he was, sick and in a hospital all the time, he was never complaining, he was never saying, why me? He said, he said, okay, this is my lot, I'm going to deal with it. But what will amaze you people is that even when he was in the hospital, in the middle of COVID, he was trading or he was bullish on India, and he would tell me when I'd go visit him, he said, Ramesh, Hindustan mein kabad hai to likh le share. There's nothing, when the market transited from a bearish COVID phase to a bullish COVID phase, he caught right at the nub. And he said, market's finished, it's not going down. And it just seemed ridiculously impossible statement to make. COVID every day was bad headline, news stories coming. We all thought the market would collapse out there. But he was crystal clear. And he was extremely stoic. He bore the pain like a true trooper. I mean, never complained.
Sir, just as a slight fun fact, when we started Zell, we had started with training offline. And the place we started was Ep3 International, which is Rakesh Jhunjhunwala's school. So on those lines, sir, if this is a slightly different question, right? You have seen the finance world of India from a very unique perspective over the last 30 years. Via Zell, we're trying to propagate financial education, and not just in the form of either qualifications or literacy. We're trying to find the balance into really how can individuals really learn, and not necessarily on the job like everybody learns right now. If you have to give us any form of suggestion or advice on how do we take the finance education of the country forward, what would you suggest us?
It's an interesting question. It's very important. First of all, I truly, whether it was your namesake Sam Zell, in terms of how much I admire him for his business acumen, is a truly extraordinary contribution to probably one of the 100 brightest minds in the field of finance. Sam Zell, along with Buffett, Munger, and Peter Lynch, and all those people out there. Most people confuse finance as not for them. They think it's the high priest, the algebra, you don't want to get into it. I'm a hairdresser, I'm a lawyer, I don't know anything about finance. That's typically the reception that you get out there. So anything you do to push the envelope further, to make it, I think it's great. It's good work. I think over 100, 200 years, we've realized that free markets are one, right? And in free markets, the equity markets are the place to invest because they give a superior rate of return to fixed deposit, real estate, gold, or any other asset class you win. Give you at least a few percentage points more than that, okay? So you need to invest in equities. We understand that now. And if you really want to do better than the few percentage points, you need to invest directly in equity. Otherwise, you just follow the index fund and track it out there. Now, I think that needs to sink into people over a period of time. So anything you can do to push that envelope, I think, is almost doing God's work because, I have a strong belief that everyone has a right and a duty to be financially free. There's a lot of Indian movies saying where the Dhani takes money away and the house away because you can't pay him back his loan or gives you a high interest loan. Yeah. And no one has to go through that kind of crap anymore. I think we've all understood what is the road to get riches, And it's not extraordinarily difficult to get rich. As Warren Buffett has said, that equity investing is not easy, but it's simple. You just follow some basic principles. Number one principle, to repeat it ad nauseum, is compounding. Learn the compounding. That's the key. You get that right, you get everything else right.
So the 0 to 1 of finance, right? That's, I think, I'd rather like to ask you that right now, like you said, the lawyers and the hairdressers, they don't know the 0 to 1 of finance. And maybe you don't need to know up to the last point, right? You don't need to know 10 on 10 of finance. But even if you know this is 0 to 1, it's enough to know that you can make the right decision that I should invest in index funds because I don't have the either diet capability, whatever it is. Right? And according to you, the 0 to 1 of teaching India finance, it's a broad question, so you can go at any direction. Do you think that it should start ideally at a very early age? Is it like how we were in BCom and that's when we sort of got introduced to finance? Is that more or less the right time for people to be introduced? Should it become a slight mandate for people to take up something which is a certification, a qualification, which is statutory in nature to learn finance? Or do you feel that on the job, the way you grew up, the way you learned, and the way the stalwarts around you learned is good enough?
I was lucky. I mean, my father was a financial background. I had friends who were financial background, so I was lucky. No, you start early as early can. Maybe in high school you start that. Maybe you have a course in, finance. I mean, by all means, I would do that. I am a bit passionate about it as you guys are because I truly believe that the P multiple, which actually makes you wealthy out there. Right. I mean, you earn 100 crores in real estate, it's worth 100 crores. You earn 100 crores in a listed company, at a multiple of 30 is worth 3,000 crores. So that's the extraordinary amount of wealth that is created in the stock market. And I'm very passionate that people should learn that. So whenever I get a chance, so if I'm invited to a college or, to a young student, so they always try to be there because it's always helpful. Not because I want to speak, but because I understand that it's important people understand how finance works, and if I can help, it would be great. And also because I learned so much from my mentors in life. So it's my way of, teaching back or giving back, if you will. So it's, it's very important we do that. I think a lot of smart people I know, or people I respect, will still tell me that I don't understand finance, we just do that. So I think they need to get over that mental hurdle. And it's just a mental hurdle. It's not something that is terribly complicated. It's the basic principles are simple. And, Warren, to give you another example, Peter Lynch always said, invest in what you know it. So what I tell them is that rather than worry about 5,000 stocks and all the geopolitical tensions going on in the world, what will happen in Ukraine, what will happen in Israel, these are things out of your control. I won't worry about those things, But if you are, for example, a doctor in India today, and you don't have to worry about all these things, but you have somewhat insight into medical companies, okay? Right. You know which company is making the latest drug for diabetes, which company is the cardiovascular pollution. So why don't we start following the pharmaceutical companies? or if you are a banker, okay, you work in one of the you know, for example, which company is hiring the best talent, or which company has the credit cards available, or which company is, putting up the most branches, or which company is getting the most clients, So focus on banking sector. Develop a circle of competency. If you're a software engineer, find a software company. That gives you insight before the last street, and that will probably help you more. So I think, like everything else, you learn to become a better tennis player, you learn to become, a better sailor. You can learn to become a better investor. It does require time, it does require patience. And if you don't have that, do the index fund. If you have that, then develop at least a skill set of a particular sector that you're more comfortable for.
Yeah, last time you had mentioned this one term that you have to be an independent thinker, and that's not something that everyone sort of realizes or absorbs. If they enter into it, it is because in the beginning they get rich quick, or what my friends are doing, and they don't develop a sense of having this independent thinking, which will give them the guts to sort of go right when the whole world is going left.
You're absolutely right. I mean, there's a hard thing because, people are more comfortable in herds. If everyone does this particular thing, I also feel comfortable doing it. It does require, zigging instead of zagging to get where you are. And you start with, say, valuation. The most important thing is in this business, valuation, getting the valuation right. Most people don't think they are good at valuation. I mean, I'm, doing a lawyer's job, or I'm doing, a job as an accountant. What do I know about valuation of business? And yet, surprisingly, you'll come up to conclusions. I mean, if I tell you, for example, to give example, which I talked previously was CMC, there were 30 crores. It doesn't require a huge leap of imagination or PhD to figure out that if I was getting the whole business 30 crores, I'd buy it. Because it doesn't make sense. It just doesn't make obvious sense. You can know this company does this kind of work for the stock exchange, for the railways, will be worth at least a few thousand crores. And yet you're getting for 30 crores. So if you keep thinking about valuations, whether it's in the hotel business, you walk into an Indian hotels at some time and see whether it's high or low. See, Warren Buffett gives a very good example that it's very helpful to think about valuation, think about investing, is that if you're playing a game of cricket, I'm not talking about T20, I'm talking about test cricket. In T20, you want to hit out every ball. But in test cricket, you don't want to hit out every ball. You want to wait. If it's nice, full toss, outside the off stump, hit it for a 6. Others keep pairing defensively. There's no penalty for doing that, right? So the stock market every day it throws out, Reliance at 2,600, Lever at 2,500, XYZ at 200. And you keep watching. And once you find that the valuation makes no sense because of your experience in a hotel business or a software business or, a liquor business, that's when you see the fat pitch outside the off stump, you hit it off the park. The equivalent of hitting out of the park is backing up the truck and buying it, So that if you have 3-4 insights in your life, you make 10x, 20x your money, and that will take care of all your problems in life. So, it's something, if you keep thinking about valuations, keep thinking about, do I want to own 2% of this business, 5% of the business? Think of buying a business, not a stock. I think that helps you tremendously in achieving your results.
I think that energy which he spoke about, he went to a group of young kids and he said, if I give you unlimited money, but you can buy one car, and that's the only car you want to drive for the rest of your life, which car would you buy? The car which is the fancier one, which is actually last
year. Yeah, you're right. There are many examples of that Buffett has given in terms of buying only 10 stocks in your life, or, buying a Tesla or an Apple, it's very important to understand what you're buying and think of yourself as the owner of the business. And I think once I kind of understood these few points, I always thought I'm owner of that business, I want to hold that business. And just like I would not sell the business because it went up 10% and 20%, I'll wait for it to be extracted in value. I think those things really help you.
So, Ramesh, I want to ask you two questions. One is and this is more of a personal question, when you're holding, whatever percentage of a business, do you actually want to ask the management question that why are you doing something this?
Well, if it's a large cap, no, because I think they're pretty they're well-oiled machine. If it's a small cap, I like to go and understand. I want to assess management more than anything else. I want to assess if they have my best interest at heart, if I understand the prospects of the businesses they do. But I'm not a big believer in frequently visiting management because they will tend to speak to you with whatever you want to hear. So, it's your job to assess it based on the numbers they provide you, based on the strategy they provide you. And I think the entry decisions are much harder than the exit decision. Exit market business can go bad for a couple of quarters. It's fine. But as long as I get a good business and a good management team, I'm okay holding it for almost unlimited periods of time.
Sure. And how do you define a good management? Basic things, basic hygiene pattern.
Just basically, first look at the track record.
Sure.
are these guys talking nonsense? Do they completely dilute the equity every time? Do their minority shareholders interest in that? The ways to judge that. I mean, it's just you go to 1, 2, 5, 10 managements, you'll be able to judge, just like, if you were judging who's the best suitor or the best spouse for my child. You figure out, is he a stable guy? Is he a good job? Is he, good with the family? You can figure it out. I think a lot of people think they can do it, and they probably can't do it because of that reason.
Yeah.
But if you give yourself enough latitude or trust your judgment, sometimes you'll be taken. Then you realize that, look, I got taken, and this is the mistake I made. I won't do that the next time. I think it's that kind of process.
Throughout your career, you've been in the business of researching a lot. What is your research pedagogy been largely?
Well, I find a lot of my friends find that astonishing, is that I run a fairly decent book, but I don't have any research analysts. I was my own research analyst. I don't hire anyone to do research because I'm supposed to do my own research. That's my job. And now my sons join me. We do it jointly, perhaps. We both try and figure out this thing. So it's not that, if you have 12 analysts here.
How would you tell the audience the basic research क्या है?
Yeah, I tell you, the basic research is what I told you in this thing. My mother told you, we want to buy things cheap. I mean, that's a universal rule that makes up that I want to buy something that's worth 100 rupees at 25 rupees. I just want to buy cheap. So I assess the valuation. That's all I do all day long is, if anyone asks me that, what do you think of XYZ stock? I'll say, what is the market cap?
Right.
So does it make sense to me?
Similar to the 30 crore example you gave, that I'd buy the business because common sense dictates.
Yeah, it was a lot of, why do they get available? So why are they so cheap for now? I don't know.
Yeah.
But occasionally companies are paying a good dividend, good cash flow, good earnings, and they're available for SON. And occasionally the same companies or different companies are available at ridiculous valuation, which make no sense to me. P's of 60, 70, the hype is on the market out there. So they're able to cut through that clutter. So I always think am I buying it cheap? And then trying to find, is there a trigger for change in that business? Is there something that's going to change it? Why will the market now come to like that business out there? Either the cash flows will continue to be strong, dividend yield will continue to grow, or the business will continue to grow. Some sort of trigger you will need, or the management is now intending to extract value from that business. So basically it boils down to that. You want to buy things cheap, and you want to find a trigger for change, and then you want to just sit back and enjoy it. Not try to be too cute. Oh, it's doubled and now it's probably going to technically correct, so sell it and buy it back, which is, kind of stupid things people tell me even today. That, because the Ukraine war is happening, I think we should get out because the market's going to go down. Yeah, it went down, then it went back up. You couldn't catch it both ways. So
I think you'll buy more when you go.
Probably, the thing is that, you realize that the long-term trajectory of the market is bullish. Yeah. So you want to remain invested in high-quality businesses. Sure. Now, does that mean that the stocks you buy won't go down? Yeah, they go down sometimes 20%, sometimes 30%, sometimes even 50%, And that's just the nature of the business. So you segregate what they call risk and volatility. Risk is the chance that you permanently lose capital. That's something we can't afford to do. Volatility is the nature of the beast. It goes up and down. So a lot of stocks I've recently, in the last 3 months, are down 15, 20% from the peak. That's just part of, I'm not that smart to be able to get every top and every bottom, and nobody is. It's tops and bottoms are fools and liars, as they say in this business. So, so they're down 20%, so they're not 20%, but they're still up instead of 7x, 5x from my bottom. So that's fine. I'm dealing with it.
And sir, so we spent close to an hour talking about intense, your entire way you approach the world of finance. Just want to unwind a bit and ask you that over the last 3-4 decades, how much ever time you've been intensely working, clearly for anybody who looks at success, right, you achieved it according to them. But in this entire period, how do you sort of unwind? How do you how do you really know how far you're going? Is it crossing, the threshold that you need to? How do you take your breaks? What's your sort of unwinding?
My unwinding is pretty easy now that I'm 60 plus. I have 2 lovely grandchildren, Veer and Arna. So to me, they're the greatest source of happiness. I think if you're too young to be fathers, but perhaps when you're grandfathers, you'll understand what I'm saying. It's actually extraordinary relief out there. I think the broader question, though, is, do you have any regrets in your life? And yes, I do. Because you can't judge your success only by, strict, absolute numbers that you've done for yourself. Here's what I tell my son, is that what was the opportunity available and how much did you extract of that opportunity? And if you extracted less than the opportunity available, then you should chide yourself for it. It's not that you're not providing or not that you're not rich or not that thing. And that's the standard which I try and use, which is, that the opportunity was so manifold for the last 30 years. Did I extract it to its, did I milk it to its full amount? Did I extract the full amount of opportunity? No, I didn't. And that bothers me a lot because you always want to be the best in what you're doing. If you're in acting, you want to win an Oscar. If you're in Olympics, you want to win the gold medal, So the two gold medalists, who I'm talking about, Rakesh Damani and Rakesh Jhunjhunwala, they were the gold medalists out there. Was I good enough to run the race to be a gold medalist? No, I wasn't. And that bothers me. It bothers me only not because of the money, because I'm well-to-do. I'm pretty comfortable in my life, But you want to be the best, and that's what I would advise all the people. You owe it to yourself to be your best version of yourself, okay? And if you didn't, it's fine. Live to fight another day. But at least understand that you fell short in that proclamation. So there's a lot of, angst in me that, I would not consider, though you've been very charitable to me, I would not consider myself the best in the business. But that doesn't mean I don't want to be the best, but I'm accepting of the fact. And what I hope is that through my lessons, some of the people I mentor, my son, can learn and try and become the best and extract the most value, because I think there's a joy on being on top of the mountain. I think, and I miss that. No matter what people tell me, I know what the greats have achieved in my business, and
But that's pretty cool, sir, because most people, especially who have this kind of experience and wisdom, they always say that don't regret. You've done your best, you've given your best, right? And it's refreshing to hear that somebody who has accomplished as much as you, at least according to the rest of us, you have this feeling of angst that no, you could have done more, or you wish you would have done.
It's not regret. Regret is in terms of monetary terms, and I don't regret that monetary terms, and that's fine. I just regret that I look at myself and say, who are the best investors out of India? And would I include myself in them? I would say no. While I've done very well for myself, monetarily I've done well for myself.
Quantitatively, yes.
Yeah, I've done well, sir. But I know what it means to be the best investor in India. And I fell short of that, maybe because I lacked the chutzpah, maybe I lack the courage, maybe I lack the fortitude. There are any number of reasons. I don't want to give excuses for my failure. But there are there are reasons for that. I regret about the other parts of it, but I just feel that we have an obligation to be our best self. Yeah. We have an obligation to ourselves. Forget what anyone says. Obligation to ourselves to be the best self, And if you fell short, I think it's, time to take some stock taking and say that, okay, son, look, these are the mistakes in my career. And hopefully you won't do that. And that's how, I guess, generations progress.
I want to end with asking you about one question. The top 3 books you recommend any person who's starting to invest or starting the journey financially?
I think basically if you read anything by Buffett and Munger, that's good. You could read Buffett's annual GM notes out there. You could read Damn Right or Charlie Munger. You could read Poor Charlie's Almanac or, Roger Lowenstein's book on Buffett. So anything on Buffett, Munger generally is, a good place to start with, Other than that, I enjoy reading a wide spectrum, biographies, political science, Peter Lynch. There's this, it's a wrong thing to say I read 3 books on investing and become good. I think you should read probably 3 books every month, to become better. Yeah. Read a balance sheet, maybe once a day, read a balance sheet, read a book. Munger often says that his wife calls him, a book with 2 legs. And I feel the same way that, when I was young, I used to read a lot. I think it's cut down now because my eyesight has become weaker. And as I said, I enjoy my grandchildren a bit more, or enjoy Netflix a bit more. So I cut down a little bit on my reading, but it's read a newspaper. The Wall Street Journal and Financial Times are great places to start with, to read those every day. And people say, what is that connection in India? Of course they can with India. You'll understand that if you read that over 5 years, Lots of great books come out, which I'm reading. For example, right now, a book which I found fascinating is How Indian Prime Minister Made Decisions by Nijat Chaudhary. Fascinating book, and, how Babri Masjid decision was made, how, Rajiv Gandhi handled the Shah Banu case or whatever, there's just understanding, So I think we read to understand the world, and as Buffett and Munger have said, that if you become a little bit smarter every day, that has a long range compounding effect. So I enjoy reading. I'm lucky. Just to give you a little bit of family. When I remember when I was very much younger, and my father would send me to go get bread from the pawwala. It would come wrapped in a newspaper, and I would be reading the newspaper on the way back. So I realized that I've been reading Time magazine and newspapers since almost I was 10 or 12 years old. I truly enjoy that. So, and luckily for me, my business requires it works out well. So rather than say 3, I think you should make reading a habit. and read the, good business newspapers and magazines, and just read biography, philosophy, investing, all of that.
Anything you find interesting and
Anything, just pick up a book and read. I think Munger goes through maybe 100 books a month or something in that. He doesn't read everything, but he reads part of it or what interests him or whatever. And that's why he's such a compounding machine. And I think Buffett is the same. If you look at Buffett's diary, he shows it to you occasionally. There are hardly any appointments. He just keeps his day free to read. And
but this is literally his job.
it's literally the job of a good investor to read. I mean, if you want to be a good investor and you say, what is the raw material? The raw material is reading. It's not how many contacts you make, how many people you talk, or whether you're in Omaha or New York, whether you're in Bombay or Bhopal. It doesn't really matter. It's how you read. And it's a way of life. You want to read in the morning, you want to read in the afternoon, you want to read in the evening. And I would strongly suggest, other than compounding, read.
Sorry, just one last question before we end. A little bit about time management, because you spoke about Buffett diary. I think a lot of people are grappling with time management. Everyone had the same 24 hours. What's your 2 cents on time management?
Well, see, when I was young, I had to struggle to make a living, so I was a broker.
Yeah.
So, sign the contracts, meet the clients, talk to them. I started doing brokerage business, so I'm only a proprietary investor. So I've generally been able to free up a lot of my time because of that. And it's something I'd recommend, you need time. If you're really busy, you're scheduled every 15 minutes, it's unlikely you're going to take the time to think or to take time out and read. So, try and cut down as much as you can. See, the minute you get past a certain point where you're, say, making more than your salary, okay? You just start weighing the odds of whether I should continue the job or continue on my dividend stream, So at some point, my income crossed my brokerage income very handsomely. Why am I doing brokerage? It makes no sense to me. I was not liking it, took a lot amount of my time and a lot of regulatory pressure. So I stopped doing that and focused on this also. We all have different responsibilities with the family, with the boards I'm on, whatever, but that's fine. But, you have to make a decision. I think that you need to realize what is important to you. If it's important to you, go out, meet people and, make so many contacts, then probably investing is not good for you.
Yes, and education by itself, man.
No, sir, we just conclude. So I think it's been over an hour. Thank you, first of all, so much for your time.
It's been an absolute pleasure.
Taking us through your journey, the journey of the Indian markets in a way over the last 30 years. A lot of advice for young kids. As now, I think a lot of people who have not seen you so far, this should prove your skills as a speaker. And just for everybody to know that there is so much more that in the last time we met, we barely had an hour of another conversation. And there was so much more you had mentioned, which had, again, so much wisdom. There's so much more behind even just this interview. So,
we for sure asking for a part 2.
Yeah.
Absolutely. I love reaching out to younger people, which I think you're trying to do. And I think you come up with a great name, Zell Education, which of course encapsulates some of the philosophy that you put together. So it'll be an absolute honor to come back and anytime.
Absolutely. Thank you so much. We hope to make you proud walking.
No, you will. You've already done. And good luck. And it's actually God's work. Educating people about finance is, God's work. And I'm glad you two young people have that drive and ambition to do it. And it's good. And I think if you can fire up a generation to learn how to invest, that's a good day's work.
Thank you so much.
Sure. Pleasure.